Good afternoon, ladies and gentlemen, RCBC clients and colleagues, guests and speakers. I'm Xavier Shalsita of RCBC Capital Corporation. Hello, everyone, and welcome to today's session. We are pleased to present to you this afternoon's learning session focusing on fixed income investments to be conducted by our colleagues, Mike and Roy, who will be formally introduced later on. We will start off by having a market update to explore and understand how the current crisis brought about by COVID-19 has affected market conditions and interest rate fluctuations. Afterwards, we will also have an interactive learning session on fixed income instruments, particularly on the features of a bond issuance. This session may also serve as a refresher on fixed income securities and how to evaluate if it makes sense for you. We hope that this information will enable you to position yourself better when an investment opportunity arises. We hope by the end of this webinar, you will have gained a new appreciation for the products presented and that these learnings may help you get a better perspective when the time comes you find yourself making an investment decision. Thank you for finding time to join us this afternoon. Please sit back, relax, and enjoy the webinar that we have prepared for you. Thank you.
Thank you, Javi. Our first speaker is the Chief Economist of RCBC. He is responsible for providing direction and strategies based on global and local economic trends, analysis of relevant industries and financial markets. Recently, he was ranked as the most accurate in predicting the Philippine GDP 2020 by the Department of Finance. He was also ranked as the most accurate in predicting the Philippine inflation rate for 2018, 2019, and 2020. Let's see if he'll once again predict the GDP and inflation rates for 2021 from his own crystal ball. Our speaker is considered a celebrity, a frequent resource person at various media companies and TV shows such as the ANC, CNN, Bloomberg, Business World, etc. To provide his hexagon insights on the world and Philippine economy and financial markets, let us all welcome Mr. Mike Ricafort.
Okay, a pleasant afternoon, everyone. Thank you so much, Claudine, for the generous introduction. So hopefully, we'll make this as productive as possible. We'll start with how we see the economy and the recovery prospects in view of the recent developments. So let me start with the summary of our economic estimates for this year and next year. Okay, next slide, please. So, well, this is a background. The GDP growth that we saw last year, that it was actually, it's not a growth, it's a contraction of 9.6%. That's the deepest since World War II. And with about 3 trillion lost in the economy, and one of the biggest contractions in ASEAN. And that's also among the longest lockdowns because the Philippines, this is unprecedented, unlike other ASEAN countries and East Asian countries. They've been used to preparing for SARS, the bird for the past 20 to 30 years. So that's why they're more ready. And some economies, they barely lock down because it's also a function of their relatively low cases. Now, going forward, it presented opportunities. Like we've seen the biggest gains in fixed income investments as yields were dramatically reduced. So prices sharply went up. So that's one of the key highlights. As central banks cut their policy rates, bond yields sharply went down in an effort by the central bank to stimulate the global economy. And bond investors made so much. And that's why even banks and other financial institutions, they made so much trading gains last year. These are unprecedented ones because our interest rates right now are at record lows, even the bond yields at some point. Now, that's why we're managing the recovery as we now enter into 2021. Of course, it's there's still there are still other parts of the world experiencing some spike in cases like India. To some extent here in the Philippines. Okay, next slide, please. We now proceed with the table, the summary table of the estimates. Now, okay, so these are our key drivers. So we have seen already the Create Law pass. So that's the biggest stimulus measure in the country that's worth at least 100 billion per year. That's put into the it's effectively more income for the largest, well, not only the largest, but both big and small corporations. Because of the tax cut of at least 5 percentage points from 30%, and that's retroactive July 1 of last year. We have seen also the for the MSMEs, we have seen a bigger reduction in tax rate. I'm talking about corporations with assets of up to 100 million pesos and net income of up to 5 billion. They have a bigger tax cut rate of 10 percentage points to 20%. So that's one of the key highlights able to help the recovery story. Also, now it would be a function of reopening the economy. That would be key to the recovery story. And it would start with controlling the new cases. And we're now experiencing some increase in the arrivals of vaccines and the deployment. And hopefully this would accelerate further by the third quarter or the fourth quarter of this year. So we need to prepare for that. But for now, we came from ECQ. 2 weeks for the first part of last month. Till now, we're at MECQ for more than 3 weeks already. So we're preparing for that. But now there's still a soft patch because of the lockdowns. There's slower economic activity, and normally that's good for bonds. In fact, the bond yields, since the tighter quarantine restrictions in the latter part of March, the bond yields have eased by about 30 to 40 basis points already from the immediate highs that we have seen the immediate highs. That's around the third week of March. And this is one of the better times for bond investors for them to get higher yields. Why am I saying this? Because we came from near record low bond yield levels. So it's very much favorable for the issuers or the borrowers, especially until January to the early part of February. But we have seen, in the US, in other parts of the world, bond yields sharply went up. Locally, we have a peculiar fundamental here. Our inflation rate spiked up, so normally we also saw the yields dramatically higher. In fact, the belly of the curve went up by almost 100 basis points, and the long end of the curve went up by as much as 150 to almost 200 basis points. But now it already eased since then. So therefore, investors, well, of course, when inflation was picking up alongside with interest rates in February till the third week of March until it reached the high. So the best way back then was to wait for the yield to top out. And we have seen it topping out already. It already tapered off alongside with inflation. And it was also fundamentally supported by the lockdowns. Because if you have slower economic activities, your inflation also eases as well as your bond yields. And it's not only happening here in the Philippines, but it's also happening in the rest of the world. Even the US 10-year benchmark yield already eased by 20 basis points after reaching a peak of 1.77 in last March 30. And now it's down by 20 basis points. It's doing around 1.57 to 1.58. So that's why since the latter part of March, the bond investors have been, some of them have already positioned and did their program purchases because they're still better off with higher yields. And of course now, while we're waiting for the recovery, there's still window for the yields to ease. So, okay, next slide, please. So, because of the lockdowns, the ECQ and MECQ, we have reduced our GDP estimate by 1 percentage point to 5 to 6%. But for next year, we're keeping it at 6.5 to 7% because of the election year. We have also reduced the exchange rate estimate by 50 centavos because that's the that's a consequence of the lockdowns. Eh. You have slower economic activity. You have less demand for imports. So there's less importation, less demand for dollars. We have seen the peso appreciating. And normally, a stronger peso also benefits the fixed income market or the bond investors because it helps lower inflation. And of course, from the point of view of foreign investors, they're also making on the currency side as well, on top of the what they would make on the fixed income. Because our interest rates, our bond yields are still relatively higher compared to many other countries around the world. So there's still the so-called carry trade opportunity. And it's still attractive for foreign investors to put their money also in Philippine fixed income because of the much higher yield. Because now it's almost zero. Look at the bond yields in Europe. It's practically zero. It's even negative if you go to the Eurozone in Germany. It has been negative for the past year or so. No? Same goes with other developed countries around the world. In Japan, it has been already negative for many years already. In the US, it hovers between now it's the 10 years at 1.50 levels. It came from 0.5 just last August. It's near zero. That's why global investors are finding value to do carry trades. And I'm talking about big fund managers, especially that our credit ratings have improved despite the COVID-19 pandemic, as I'll be showing later on. The lockdowns have also reduced our inflation, as we mentioned, because less demand, less economic activities, the inflation tapered off. And there's good news already that came from Malacanang just 1 or 2 hours ago. President Duterte already approved the increased importation of pork. So that would effectively reduce the price of pork with lower tariffs and higher import volumes. Hopefully, pork prices would go down and the headline inflation would ease further. Now, the lockdowns have also made the monetary authorities to be more accommodative in their monetary policy stance because the economy needs all the support that it can get. So therefore, there's a need to keep interest rates at the record low of 2%. Despite the spike in inflation that we have seen in the early part of the year. Even U.S. interest rates, the Fed officials are of the consensus that it would remain close to zero. The Fed funds rate, the policy rate in the U.S., the key short-term interest rate, that would remain zero until 2023. That's why investors are searching for higher returns around the world, and that includes the Philippine fixed income, where yields are still much higher compared to developed countries. We're not just talking about here in the Philippines, but also global fund managers trying to maximize the return of the funds that they manage for their wealth clients, for their pension funds, retirement funds, trust funds, etc. Now, we also reduced the PSEI estimate to 7 to 7.5 because of course, because the lockdowns reduced sales, income, and valuations. Okay, let's now, hopefully by next year, things would get better for across the metrics, across the economic data that we're monitoring. And inflation, hopefully, would go down to even below 3% because that's how we see inflation. Inflation, that's the most important fundamental for the bond market because when inflation went up late last year to early this year, our yields went up from record low levels because there's nowhere to go but up. We are enjoying very low interest rates and bond yields. So they corrected higher, but now at least investors are better off with higher returns compared to January to February levels. Okay, next slide, please. Even the GDP estimates, the credit rating agencies and the multilateral agencies, they still see a growth of at least 6 to 7% for the next 3 years, 2021 to 2023. Next year being an election year, that's expected. The GDP data that came out this morning was minus 4.2%. Expectation was around minus 3%. But nonetheless, that's still an improvement compared to minus 8.3% in the fourth quarter and minus 11% in the third quarter. And the worst was minus 17% in the second quarter of next year. That's why we're expecting, because of the low base, because we're coming from negative 17% a year ago in the second quarter, we expect possible double-digit growth in the economy as a result. But because of that, primarily of the very low base effects. Okay, next slide, please. Yeah, the credit rating agencies, this is very important especially from the point of view of foreign investors, the fund managers that also come here in the Philippines. Of all times, during the lockdown, our credit rating was upgraded by Japan Credit Rating Agency to the first ever A rating in Philippine history. That's well above the investment grade spectrum. And we have seen the affirmation of the country's credit ratings so far since last year, despite the COVID-19 pandemic, because other countries were downgraded. So because of the improved fiscal management, our debt to GDP ratio is still relatively lower compared to other countries in ASEAN and for the rest of Asia and the world, because of the fiscal discipline. So because the debt to GDP, it was 39.6% in end 2019 before the pandemic. Last year, it went up to 54.5%. That's still below the international threshold of 60%. And that's still way below, that's still below compared to other countries in the region and in the rest of the world, especially as everybody else did stimulus spending. So this is a big plus. That's why our interest rates and the cost of borrowing of the government has been lower, and that has benefited our other borrowers as well. Because from the point of view of international investors and creditors, our credit rating is favorable. So that would warrant less risk premium, or they need to pay less. That's why our bond yields are throughout the country's history, this is still among the lowest levels. Okay, next slide, please. Yeah, this is just a review of what we have discussed a while ago. So Malacanang already announced that the next quarantine classification for NCR class will be this coming Friday because of the holiday on Thursday. So as long as the cases remain relatively elevated, as we're still waiting for more vaccines, much more vaccines in the third quarter and fourth quarter, we're still in. But there's still this economic slowdown in economic activities that slows down inflation, and that's favorable for our bond investors. Okay, next slide, please. At least inflation is also easing. So where do we see the economy? When would the economy recover back to pre-COVID-19 levels? So it would be around the latter part of 2022, based on the base case estimates that we're using. Hopefully, it would depend on the lockdowns going forward, because the more extended the lockdowns become, it would also delay the recovery back to pre-COVID cases, pre-COVID levels for the economy. Next slide, please. Yeah, at least this is already the new case. The new cases on a daily basis. It came from a record high of 15,298 last April 2. Yeah, of all times, we have seen the spike in new COVID-19 cases in March when the vaccines arrived, of all times, because of the new variants. Yeah, primarily because of the new variants that came into the country. Yeah, that's why we were all shocked. This was unforeseen. Everybody else was surprised. So at least now it's less than half. It's now hovering between 6,000 to 7,000 per day. That's less than half of the 15,000 that we have seen. And hopefully, at least the vaccines we have seen the large volumes already picking up in the volumes, in the vaccines. The 2 million from AstraZeneca last Saturday. Last Friday, we have the 1.5 million from Sinovac. So there are more than 7 million vaccines already in the country. And I think the ranking of the Philippines in terms of vaccination in ASEAN, it's now number 2. No, at least despite all, at the start, of course, there were delays, but now we're now number 2. We're after Indonesia. We already overtook Singapore with the most number of vaccinations, and hopefully more vaccines would come, especially the Gamaleya. There may be some delay on the vaccine from India, but it's offset by the Western vaccines like Pfizer. Pfizer it has arrived already yesterday, the initial batch, the 193,000. Hopefully, there will be millions more down the road. Same goes for AstraZeneca, for Gamaleya, and Sinovac. And hopefully, Moderna would follow suit. Okay, next slide, please. So as long as this, well, we're still monitoring the recovery. But for the meantime, there's still a window for fixed income to thrive since the latter part of March. So this is the summary table for which. So for this month it was upgraded to 7 million from 4 million, and by June it would be 10 million, July 13 million, August to September 15 to 20 million per month. Okay, so we have that window. Okay, next slide, please. Yeah, these are the suppliers that we have mentioned. Okay, next slide, please. Yeah. Okay, next slide. It's just the Novavax from India that would be delayed now. No. And hopefully kasi almost done na rin yung developed countries. They have some of them already have excess supply. So that's why it's time to export their vaccines to countries like the Philippines. So as mentioned, this is with the summary for the other facts here is that on top of the tapering of inflation, there's still excess liquidity in the financial system. We have 1.7 trillion of excess liquidity. That's why our bond market has been well supported also lately, because there's just so much money in the system, and that's what the central banks want, able to keep borrowing rates low, and with that we are all helping the economy. Because if there would be more bond issuances by the government and the corporate, and we invest in it, we're supporting the recovery story. We're financing first the expansion of government spending, the increased corporate spending on capex, on investments, and they create jobs. No, it's also being part of a patriotic, being invested also, and the timing is, of course. Timing is everything, and this timing is still favorable at this point. Even in the US, they're doing a lot of stimulus measures to spur the recovery. Joe Biden is doing many stimulus measures, 1.8 trillion at the latest for households, 2.25 trillion for infra, and 1.9 trillion for the relief measure, the stimulus. At the start of that was in March. So same goes. Many governments are doing that. That's part of the reason from record low levels, the bond yields went up. And that has benefited the investors. At least they could enjoy higher yields. Okay, next slide, please. So both the borrowers and the investors are happy. The exchange rate, now it's doing at 47.80 levels. No? So that's the strongest in 4.5 years because of the reduced importation. And that has benefited the bond markets. Whenever the peso is stronger, it's good for bonds. No? Because foreign investors are also putting in money here in the country. They're making money also on the exchange rate. No? The appreciation of the peso, they make money on that. They are also making money on the higher yields here in the Philippine fixed income market. Equities, at least well supported at 6,300 levels, no? Despite the worst of the lockdowns, because US stock markets are record highs. It would still be liquidity-driven gains that would support both the stock markets and the fixed income market. And the question is, where in the market, where do we see the biggest returns? Lately, we have seen a lot of action on crypto, but now it's game over. We have seen profit taking already on Dogecoin. So at least some of what normally that involves smaller funds. So as people and some of the investors take profits on their lucrative trades, they also park their money on fixed income. Of course, they won't park it in cash. They won't earn that much. So they have to put in fixed income where the yields are higher, especially for fund managers. Of course, the professional fund managers would only be allowed to investments with higher credit rating, especially, of course, they're managing pensions, the retirement of people, and their principals, their wealth principals, and so on. Okay, next slide, please. Yeah, this is the external factor, the 10-year bond yield. So that is still, well, at least this is a good sign. It tapped out already. This is, well, those who have been waiting for too long, since late last year, at least the investors could already consider putting money. Because they could optimize the yields. Imagine, investors now can put at much higher interest rate. They're better off by more than 100 basis points now. In the US and in many other countries. So, yeah. Okay, next slide, please. That's why we followed a similar pattern. Although it's still up by 66 basis points, meaning investors are better off with higher interest rate returns. Okay? At least they're investing already at much higher rates. Okay, next slide, please. Yeah, the short-term money, this is almost cash. 3-month LIBOR posted a record low of 0.16, almost zero. That's why people are going to the longer end of the yield curve. They go to the belly, the 2-3 year, and even longer than that to get return because it's almost zero. They need to manage their funds and try to. Of course, they need to battle inflation as well, and this is one way to do it. They go longer term. They go to the bond market. Okay. Next slide, please. At the same time, the bond markets are among the safest investments around. So the LIBOR is already down by 8 basis points. By the way, LIBOR is scheduled to be ready to end by this year. That's why preparations are already being made for the next benchmark for the dollar funds. Okay, next slide, please. This is the oil price. That's one of the reasons why our yields went up. Well, why did yields went up in the first place? Because of the recovery, especially in the US. More than 200, nearly 250 million vaccine doses administered. So cases went down. Wow, I think they're just down to 30 to 40,000 per day from a high of more than 200,000 just in February, early this year, because of the increased vaccinations. So the recovery story picked up. There would be more people employed. There would be more economic activities. And that's true for the two biggest economies, at least for the US, which is the biggest economy in China. That's why yields went up. Even the demand for commodities like oil went up. Of course, if your oil goes up, fundamentally, the bond yields also follow. Because we came from record low levels. Nowhere to go but up. Okay, next slide. Especially for developed countries. So oil is already up by 33%. Okay, next slide, please. Yeah, this is the exchange rate. So we've seen it. Wow. The next support is 47.70, and the 9-year 50% retracement is 47.40. Well, at least now it's halfway. The peak of 54 in 2018 and the low of 40. Because either direction, when it was high, importers were complaining. When it was low, the dollar earners were complaining. Now we're halfway, so no one is complaining now. And that's normally the stronger peso. You see the downward correction here on the dollar. That's good for fixed income because in the process, the foreign funds, they're making money out of it also. Okay. Next slide, please. Yeah, the peso already appreciated by 16 centavos of 0.3%. Then that's good for also in helping ease inflation. Okay. Next slide, please. And this is our inflation. Well, we all know it's supply side. Hopefully, it's just really transitory or temporary supply side factors. It was triggered by the storms late last year, the storm damage on the crops and vegetables. Now it's done and over with. Pork prices, hopefully, they're working on it. Increase imports at lower tariffs, hopefully. The only challenge that we need to manage is the global commodity prices, the highest in 8 to 10 years, including oil, the highest in about 2.5 years. That's beyond our control, but hopefully, because there's so much excess liquidity, they're also playing the commodities. Of course, the recovery is fast in the US and in China. China is the biggest importer, but hopefully these are supply side factors because anyway, there's not much pricing power. At some point, they cannot just increase prices because of high commodity. At some point, it has to adjust with the realities. We're still all recovering from the pandemic around the world. Okay, next slide, please. So this is how we see inflation. Now at 4% levels. to average 4.2. Yeah, it would remain elevated until around. That's why it's benefiting the yields. That's why yields already corrected higher. They already adjusted higher to familiar levels. It's already at fair value. Even if you look at our long-term inflation estimate is around 3%. Because this is unusual because of the unique supply side factors. The higher food prices, the higher pork prices, especially after the storms in November till early this year. So hopefully all those things are temporary. We would eventually go back to 3%. Okay? And hopefully the lower pork prices also would bring down this inflation rate further. Maybe at least 30 basis points. It could go down to our average of less than 4%. Next slide, please. Yan. By the election year, because of the base effects, we will be back to even a little less than 3%. That's halfway of the 2 to 4% target of the BSP. So that's fair for everybody. If you make a valuation on your bond yields now, yeah, they're already at fair value relative to this one, to long-term inflation expectation. At least it's enough to cover them for the effects of inflation. If you go the longer end of the curve or the bond yields. Okay, next slide, please. Yeah, this is the most important column here is the last column. So, we have seen the yields already easing. That's good news for the investors. At least the yields have already eased. The immediate high was posted in the third week of March. So I'll be showing the graphs later on. So so this is favorable for investors already. At least we have seen the peak already, so they could enjoy the higher yields. Okay, next slide, please. Yeah, again, please focus on the last column. The yields are still higher for the belly of the curve. It's still higher by 60 to 80 basis points. But for the other long term, the long end of the curve, it's still up by as much as 100 to 150 basis points. What does this mean? If you're investing now, since yields are much higher, at least the big moves, we have seen the big moves already, the investors are better off with higher returns for their investment. Because that 1% increase, this is very important for fund managers, especially the retirees. No? Not only the retirees, but the high wealth individuals, the wealth management funds, the trust funds. If you have 10 million seed money, that's an additional 100,000 pesos per year. If you have 100 million, that's an additional, if you have 10 million, that's 100,000 pesos per year. If you have 100 million, that's an additional 1 million pesos. Especially, this would matter, especially for our elderly, our retired people who live in interest. The same goes with the other funds, the retirement funds, the pension funds. So they're better off. That's why it's important that we have seen this upward adjustment in the yields, and our investors are reaping the benefits. For those with 1 billion, yeah, they're earning 10 million pesos more per year. Okay, next slide. Just for that increment. It only increased last February to March. This is still the excess liquidity in the financial system because that's part of the BSP's measures. We still have 1.4 trillion parked by banks with the BSP's TDF and ODF facility. They're just parking it there. Okay, next slide, please. Yeah, that's near the highest that we have seen 8 years ago. Okay, next slide, please. On a daily basis, this is called the banks also park at the overnight facility of the BSP. Every day they roll it over. 300 billion. So you add the two, you have 1.7 trillion in excess liquidity. That's an increment of 1 trillion since the pandemic started. So we have excess funds. That's why our interest rates remain relative, especially the short-term interest rate. Because demand and supply, you have money, you have much more money, so the cost of funds go down, especially in the short term. and that's what they want. No, that's what the central banks want, enable to stimulate the economy. Okay, to stimulate borrowing. Next slide, please. Oh, this is also, at least for the fixed income market, it was good timing. There were maturities of almost 200 billion in bonds. There was a maturity, and then and hopefully by June there would be another maturity. So that's why there's still good reason fundamentally with the slower, because of the lockdowns. You have slower recovery. You have also excess liquidity coming in. These are maturing funds. Maturing for June. That's 3-year RTB. RTB maturing. So they would look for returns, no, as they mature. They would again hunt the in the fixed income market, especially if that's allowed under their mandate for the professional fund managers, and that's also allowed by the risk profiles, the allowable, their risk tolerance. Okay, next slide, please. Yeah, next year there won't be much, there won't be much maturity, especially towards the elections. Okay, next slide, please. Yeah. Yeah, now let's now move to the, this is the last part of my presentation. I'd like to show you the graphs, just to illustrate what we have been talking about. The 3-month money, it's still among record low at 1.3. So borrowers are very happy to borrow at this rate. But because there's so much excess liquidity, that's why it's way below inflation. Okay, next slide, please. But we have seen already at the bottom. So it's still up by 20 basis points. It's not only happening here, but around the world. Okay, next slide, please. This is the swap rate, the 3-month swap rate. That's similarly at a little over 1%. Okay, next slide, please. For short-term money, this is now the belly of the curve. A lot of borrowers are here. A lot of corporate bond issues are here. The 2-year up to 5-year spectrum. So now it's at 2.27. So it's still down by 30 basis points from the immediate high. So the investors are a bit lucky already because it has stopped out already for now. So they get to enjoy. Well, unlike when they invested it here, they only got much lower yield. No? But now they're way better off. No? Okay, next slide, please. This is for the 3 years. So it already is by 30 basis points also. No? Because this is one of the better times. If you're a bond investor, in terms of yield, this is where you, the strategic purchases for fixed income should be made if it tops out. So, okay, next slide, please. So it's still up by 55 basis points. Okay, next slide, please. And here's for the 5-year. Imagine, no, from where it came. The record low was 2.32. Now it's at 3.2. So it's up by more than by about 100 basis, almost 100 basis points from the record low. So you're better off now if you're investing here. And you know for a fact that it already stopped going up. So you could optimize. You could optimize the interest rate return that you get, as an investor. Now the borrowers also, it's a win-win also for the borrowers because realistically it won't go down anymore to the record lows. From the point of view of the borrowers, they just play the correction here while the economic conditions and the recovery remain soft. Kasi the timeline, come 3rd, 4th quarter, the recovery might pick up. There will be election-related preparations already, by the second half of the year. There will be more spending. Of course, by the time the election comes, by May of next year, that's exactly exactly a year from now, rather. So they should be ready. There will be preparations, and there would be recovery story in the process. Okay, hopefully, even after next year, these are already fair market value for the various interest rates at the rate that we're going. Okay, next slide, please. So it's already up by 68 basis points. So investors are better off since the start of the year by 70 basis points. As we mentioned a while ago, it would really matter for especially the bigger the fund becomes. Yeah, okay, next slide, please. And for the 10-year, the 10-year, look at how sharply it has gone down from 2.62 last August. Now it's up by by 100, more than 150 basis points. So you get to invest now at 4% levels rather than when it was at the record low, it was at 2 to 3% levels. So you'll be making much more money now. And you're comforted by the fact that at least we have seen the peak already. You are trying to grab the interest rate return that we are trying to optimize it at the highest or near the peak at least, and you get to enjoy that return. And because of the slower recovery, there's still room for that to correct, maybe towards another 15 to 20 basis points from where we are. Okay, next slide, please. Yeah, it's still up by, started the year by 150 basis points. Now, at this juncture, I'd like to end my presentation. So should you have your questions, please feel free to raise them later. Now, so thank you so much, and stay safe, everyone. So please feel free to interact with us later in the Q&A. So I'd like to turn the floor over to Claudine. Thank you so much.
Thank you, Mike. And yes, good to know that better times ahead expected, and we're on our way to recovery. The individuals on their way to recovery as well. So looking forward to better times ahead. For those who may have questions, you may type in your questions in the Q&A box, and we'll be happy to take them to discuss them one by one when we move to the Q&A portion. Okay. Our next presenter is the head of client advisory and brokering of the Treasury Group, a team that is responsible for seeking and identifying investment ideas and opportunities for the bank's clients, ranging from cash bonds, high-yield credits, and structured products. He has over 12 years of experience in the investment industry across different roles, ranging from global markets and treasury, risk management, investment management, and corporate lending. A licensed fixed income salesman, treasury certified professional, and a CFA. To provide a refresher on fixed income, the standard terms to look for, the expected returns calculator, and to explain how the put option for the SMC bond issue may be applied, friends, let's welcome Mr. Roy Velasco.
Hi, good afternoon, everyone. So, hello, can you hear me?
Yes, we can hear you.
Thank you. Just checking. So this would be an overview on fixed income. So if you have any questions, I'm just going to be running through the presentation quite quickly because I think we're running out of time already. So I'm going to be going through it quickly. If you have any questions, kindly type them in the chat box, and we will try our best to address your questions in the Q&A portion later. Okay, so some of the concept might be difficult to grasp. So I would really appreciate if you could type down your questions immediately so we can address them later. All right, moving on to the first slide. So fixed income. So I'm sure most of you are already familiar. So fixed income is generally a type of loan that you make to the issuer. So there are several kinds of issuers. One will be government. Banks are also frequent issuers of fixed income securities. And also, of course, the corporate borrowers. So you are lending to them, and the issuer will promise you a certain return on your investment, which we call the coupon. We will talk about more of those concepts in subsequent slides. But for this slide, we try to cover what are the general and the typical fixed income securities that we would encounter here in the Philippines. So those issued by the government, you have the treasury bills, treasury bonds, and treasury notes. The only difference here is really the tenor. So treasury bills are generally less than 1 year. Treasury notes are from 1 year to 7 years, and treasury bonds are longer than 7 years. Then you also have ROP bonds and global peso notes. ROP bonds, these are dollar bonds issued by the Philippine government and floated in the international market. So these ones will not carry any withholding tax, if I'm not mistaken. Then the same thing for global peso notes. This is also an international bond, but this one is peso denominated but settled in US dollars. If you have any questions about that, just type it down and we'll explain to you further later. But right now, I would assume that a lot of you are already familiar. for banks. So what are the fixed income products issued by banks? So let us start off with time deposits. Time deposit is a deposit product, but it is also considered to be a fixed income product. Then later on, you have the certificates of deposits or LTNCDs issued by banks. So those are also fixed income instruments. Then you have loans. Then the ones that are traded publicly, although LTNCDs are also traded, but the most common will be bonds, long-term bonds issued by banks. So we have seen several of those last year, also coming from RCBC. And capital securities. So for example, you have lower tier 2, tier 1 securities. So those will count as a buffer against the capital of the bank. So those are also considered fixed income products. In certain cases, some people will classify preferred shares as fixed income, and some will also classify them as equity. So it's kind of a mix between, it's a hybrid. And the reason it is a hybrid is because it has a higher loss absorption capacity. So that makes it more of an equity-like security than a fixed income security. So corporates, the instrument issued by corporates, commercial papers. So these are the very short term, and these are also traded in the market. And you have also promissory notes. Promissory notes are more private fixed income instruments because you cannot really trade this publicly. This will be issued in the name of the person who is purchasing it, the person or entity who will be investing. And then, of course, corporate notes, then bonds. The corporate bonds, they can be zero coupon, they can be fixed rate bonds, and they can also be floating rate instruments. Moving on to the next slide. So here we are looking at the potential risk return trade-off for several of the instruments that we are talking about today. So the fixed income instruments generally have lower risk compared to the others that you see in the market. So right here, those are equity instruments. So fixed income, you have the US Treasury securities, which is at the lowest. They have the lowest risk and the lowest volatility. And so they also carry the lowest return. So they also promise the lowest return because the investors are really bearing a very small amount of risk relative to the other assets. Then after that, you have brokered certificate of deposits, then investment grade bonds. High yield bonds will be upper in the chart. So they have a higher amount of risk. So they also carry a higher potential reward or a higher amount of return. Then, of course, at the end of the spectrum, you are going to see equities, international equities, and domestic equities. So bonds, what we're trying to show here in this chart is really the risk-reward trade-off between these type of instruments, comparing fixed income and equities. So fixed income instruments, generally, they are going to promise you only a fixed amount of return. So that is all that the investor is going to receive throughout the life of the instrument. But for equities, there can be a lot of volatility, but also, of course, the upside can be unlimited. So in general, if you're talking about a period of 10 years, you might see equities increasing by over 30%, or some even will more than double their value. But for a 10-year bond, it would be unusual for you to receive a return that is larger than 10% unless you're talking about really high yield securities. So, but the difference between equities and bonds is that equity will only receive the residual income after all of the obligations to bondholders or to fixed income liabilities have been already addressed. Next slide. So some important terms that we are going to discuss. First is the issuer. So the issuer that you are going to encounter in the term sheet is the entity that is issuing the bonds or the entity that is borrowing the money. So this can be, for example, the Republic of the Philippines, if you're talking about retail treasury bonds, or RTP or GPNs. So this will be also, for example, later on, we're going to discuss one example, which is San Miguel Corporation. So they are an issuer of several types of fixed income instruments. So why is this important? I think because the issuer generally is the main factor to consider when we are investing in fixed income instruments, because they also carry the largest amount of risk. So when a retail investor is looking to whether they should participate in a certain fixed income issuance, they first look at who is the issuer. So is this a big blue chip entity? Do I know this name? Have I encountered it? So is this Jollibee, or is this RCBC? Is this Ayala Corporation, or is this some entity that I've never heard before? What industry do they operate in? So is this industry stable, or do they have a diversified business? And are they more immune to downturns like what we are experiencing today? A lot of the restaurants have to close down. Do they have sufficient liquidity to weather the storm? Those kind of things. So it's not a very simple undertaking to do. But I think we are aided in our analysis by the availability of certain rating agencies. So they provide quality ratings, and we are going to cover that more later on as we go down the presentation. And then the next thing that you will encounter in the term sheet, this is called the face value. So the face value is the amount owed by the issuer to the bondholders. So what this says is that this is the total amount that has been borrowed by the issuer and is now owed to the bondholders. Then the next one will be the coupon rate. The coupon rate is the regular interest income to be received by the bondholder. So in certain cases, this can also be a floating rate. So, but most of the time, what you will encounter is that the interest rate is fixed. Sometimes they can also reprice, but in general, let's assume for now that this is a fixed return. So this is a fixed return that the bondholder, or that the issuer, promises to pay the bondholder over the life of the bond. So this one is expressed as a percentage of the face value and as an annual return. So even if it pays quarterly or semi-annually, the return is always annual. So if you're talking about 6% return paid semi-annually, you're going to receive 3% twice a year, which makes it 6% total. Next one is discount rate. So this applies only to zero coupon bonds. So the concept of zero coupon bonds is that they are still a fixed income instrument, but since they are zero coupon, they don't pay any coupons. So instead, the investor is going to receive their return from the discount that is offered. So that's kind of akin to your coupon rate already. So what happens is that the issuer is going to issue the security at a discount and redeem it at par. This is common for very short-term issuances like commercial papers, short-term promissory notes, and even treasury bills issued by the Philippine government. So they will be issued, for example, for a 3% discount. So that means for every 100 face value, they are going to issue it to you at 97 today, then maybe redeem it at 100 after 90 days. Maturity, so this is the date on which the face value of the bond is expected to be fully repaid. And then yield, this is the anticipated return on investment that the bondholder is expected to receive from the bond. So this is not the same as the coupon rate. The coupon rate is the fixed interest payments received by the bondholder, and the yield is the return on investment that the bondholder will receive. So if the investor purchased the bonds at issuance, so the yield is going to equal the coupon rate most of the time. And if he holds on to the bonds until maturity, then the return he receives will be equal to the coupon rate. So that is the concept there. But if you are going to purchase the bond in the secondary market after interest rates have already moved, so the price of the bond is going to change, then the return that the investor is going to receive for the bond will also be different. We're going to cover that concept more later on. And then the next concept here is the price. So the price is the price at which the bonds may be purchased and sold in the market per 100 par. So we have a spreadsheet later, and we are going to show you how to read a bond spreadsheet. So a lot of the concepts that we discussed here are also available there. So, but I think first of all, let's cover the relationship between yield and price. So there is a small chart here at the bottom right, which is color green. So what you would observe here is that as yields decrease, the price of a bond is expected to increase. And as yields increase, the price of the bond is expected to decrease. So there is an inverse relationship between yield and price. That's why we say that the coupon rate does not always equal the yield, because the yield and the price move during the life of the bond. So the explanation here is simple, because for most fixed rate bonds, um, you are going to receive a fixed return throughout the life of your investment. But if, for example, the interest rates during the life of the bond decreases, but the bond that you are holding still pays a fixed coupon. For example, it's 6%. It was issued at a coupon of 6%. Then the level of interest rates after 2 years decreased to 3%. So essentially, the new bonds that are issued in the market are just yielding 3% to the new investors. But if they purchase your bond, it is going to yield them 6%. So essentially, if they want to get hold of your bond, they will have to pay a premium to obtain it. So that is the reason why they move inverse to yields. Then the last item that I have put here. By the way, this list is not exhaustive. There are several more terms that you are going to encounter in the term sheet. I just listed down some of the most important concepts that we are going to likely to encounter. So the last item that I listed here is seniority. Ranking, sorry. So this is the seniority of the bond with regard to the order of repayment during bankruptcy. So what this means is that, for example, if at any point during the life of the bond, the issuer goes into default, meaning they are unable to service their obligations anymore, the most senior securities will be repaid first, followed by the second lien. So that's the senior debt. Then you have second lien, the subordinated debt. Then if there's anything left over, it will be used to repay the preferred shareholders and the common stock. So essentially, the safest investment will be at the most senior level. So that's generally, in the Philippines, we call them senior unsecured debt. Then you have junior debt or subordinated debt. Of course, this also shows us the relationship. If you have more risk, meaning if you are investing in the lower rank securities, there will also be higher returns. And if you are investing in the most senior securities, the returns will also be lower. Next slide. So in this slide, we are going to discuss more about the relationship between price, yield, and the tenor, the years to maturity of a certain bond. So what we are showing here is that we are going to spend some time in this slide. So at the left, you have the bond price. At the bottom, you have years to maturity. And these lines here, these curves, are certain levels of interest rates. So for example, at the top part, you have a premium bond, meaning the coupon rate of the bond is 10%, as you see here at the green box right there. So the coupon of the bond is 10%. So given the inverse relationship, if yields drop to 8% or 9%, the bond price will be trading at a premium, meaning it's gonna trade over 100. Now, the inverse is also true. So if the level of interest rates actually increase to 11% or 12%, then the bond will now be trading at a discount. Also, if you would see that as you move on down the tenor, like if you are going to 25 years, you would notice that the variation between the prices is larger. So the longer the tenor of the bond or the longer the time to maturity, the price variation is going to be larger compared to shorter tenor bonds. So even if they have the same coupon rate, the same level of interest, but one has a very long tenor compared to the other, the longer tenor bond will have a larger price variation. So this concept is also known as duration, but we are not going to talk about that in this presentation. So it's just that we would like to highlight that what affects the volatility of the bond. Number one is the tenor of the bond, it affects it. Number two is the level of the interest rates. And number three is the coupon. So if the coupon of the bond is high, it is going to have a lower volatility as well. So that's an important concept that we would like to highlight here. And as the bond approaches maturity, so for example, you have a 25-year bond, and after 20 years, so you're down to the first notch here, which is 5 years. So you're very close to maturity. the volatility of the bond, the price variation is going to reduce. So it's not going to move as much. So instead of moving from 100 to 120 when interest rates move from 10% to 8%, it's now just about 107 or 108. So the price variation is going to reduce. And as you get closer to maturity, if you're talking about a few months or a few days to maturity, there is a concept called pull to par. So meaning the price of the bond will approach the par value, which is the face value of the bond. Bakit? Because at maturity date, the investor is going to receive the principal value from the issuer, assuming, of course, that they do not default. So that's the concept. So meaning, as you move closer to maturity, the price of the bond should approach its face value. Okay, next slide. Next, we're going to be talking about bonds optionality, and we have an example about this later. So optionality, there are several variations of this one, but for this presentation, we're going to talk about three. Number one is you have a call option. This is the option by the issuer to redeem the bonds early. So the flexibility is actually accorded to the issuer if you have a call option. So it's a disadvantage for the bondholder. And the second one is a put option. So the put option is now an option by the bondholder to force the issuer to redeem the notes or the bonds early. So if the bond has a put option, what happens is that at the put option date, because you can only exercise these options at certain points in time. For example, you can exercise after 3 years or after 4 years. At the 4th year, the bondholder can decide, the bondholder with a put option can decide if they want the issuer to redeem the bonds. So that's the concept of that one. Then later on, you also have convertibility. So convertibility is the option by the bondholder to convert the bonds into equity. But this is, I would say, not commonly encountered here in the Philippines. So what is more common is really call options and put options. So because the call option is a benefit to the bond, to the issuer, the way to really compensate the bondholder for this is by providing the step-up rate. So we are going to talk about the step-up rate here at the bottom. So the concept of this one is that really on pricing date, how we price a bond is you have a benchmark rate plus an initial credit spread. So that is going to be the coupon rate that is published in the term sheet. So now, if, for example, you're talking about a perpetual security, because we also have certain bonds which do not have maturities. So most of the time they have a fixed maturity, but in certain cases, if you're talking about a perpetual bond, this one doesn't have a fixed maturity, but they have several call options. So the issuer can call them, for example, in 5 years and in every coupon date thereafter, or in 5 years and in every 5 years thereafter. So what happens is that to incentivize the issuer to redeem the bonds, you have a concept called the step-up rate. So meaning, on the call date, if the bonds are not called, the interest rate on the issuance is going to increase in certain cases by a very large margin. So in this example, for example, what happened is that on repricing date, the benchmark rate increased to 0.5%. From initially it was 0.31%. So by the time it's repriced or on the call date, it's now 0.5%. Then you add back the initial credit spread at issuance date, which is 6.99%, plus a step-up rate of 2.5%. So the ending yield is now 9.99%. So this can be quite punitive. So you are punishing the issuer for not calling the bonds. So in most instances, because the bond coupon is going to be very expensive for the issuer, they would most likely call the bonds and just reissue them at a cheaper rate, assuming they have the capability to do so. But this is the concept why you have a step-up rate when there is a call option of the bond attached to it. Next slide. Okay, key risks for investing in fixed income. So the first one, we touched on this earlier slightly. So this is the concept of credit risk. So what this means is that the credit risk is really the risk that the bondholder will not be able to service its obligations. So it can be missing an interest payment or missing the principal, which is very dangerous because this is the biggest risk. That's why I mentioned earlier that the quality of the issuer is always a primary consideration when investing in fixed income securities because the loss can be tremendous if you choose the wrong issuer. So for example, if it's not a high quality issuer and they default, you risk losing your entire capital. Compared to the others, like for example, if you're talking about interest rate risk, in general, as long as there will be some volatility in between, but if you are holding the bond to maturity, you should be able to get your principal back. Or if you sell it in the secondary market and the price is lower, you will still receive a substantial portion of your invested capital. But if the issuer defaults and they go through liquidation, you're just going to get a residual value. So meaning, kung ano na lang matirang pera, they have to sell off the assets of the issuer, then whatever is recovered, that is going to be used to pay the obligations, so including the debt obligations. So the bond coupon, like we discussed earlier, is set as a risk-free rate plus a credit spread. The risk-free rate is generally your government issuer because in any country, the government is considered to be risk-free. So that is the highest quality issuer because they have the capability to print currency. So for example, if you're talking about the Philippines, so who is the risk-free issuer of Philippine bonds? That will be the Philippine government. Who is the risk-free issuer of USD bonds? That will be the US Treasury because they have the capability to tax the population and print money to be able to service their obligations. Now, to aid in our analysis, because this is not a very simple undertaking, analyzing the credit risk of a certain security, most of us will just rely on the credit ratings assigned by some of the most reliable agencies. So in this table, we have Moody's, Fitch, and S&P, and the ratings are actually grouped from investment grade to sub-investment grade, or what others would also consider junk. So below investment grade, I prefer to call it below investment grade. So anything above BBB will be investment grade. So currently the Philippines is in the BBB bucket. So we are considered to be investment grade already. And then anything less than BBB minus, so anything that has double two Bs only, single B, or Cs, those are all considered to be sub-investment grade, or some people would call them junk bonds. So in terms of risk, so the highest quality will of course be the AAA securities, and the lowest ones, D or C, will be in default, and you can call the high yield bonds as speculative or highly speculative. So the low portion of the investment grade, like where the Philippines is considered medium grade. And another thing to note is that the ratings will also differ per currency. So for example, you have a foreign currency rating and you have a local currency rating. So it depends on what kind of currency is being issued. So the higher credit ratings, of course, have lower credit spread, and the lower credit ratings have a higher credit spread. So also, in relation to the tenor, the longer the tenor, because there's more risk attached to it, as I explained earlier, there's more volatility in the price, and a lot of things can happen in between. Like, for example, if you're talking about 20 years, you don't know what's going to happen. Are we going to have a recession? Are we going to have a major natural catastrophe? Or is the business going to be obsolete? Like, for example, smartphone maker or chip maker, are they still going to be around? Or coal power plants, are they still going to be there? Are they going to be replaced by renewable energy? So there's a lot more uncertainty if you're talking about longer tenors. So the longer tenors are also accompanied by high credit spreads relative to shorter tenors. Next slide. So hypothetical yield curves. So this one we already touched on slightly. So for government bonds, because they have the highest rating, so they will have flatter yield curves. So this is also called the term structure of interest rates for a certain security. So the highest rated ones will be relatively flat, although still upward sloping, and the most speculative ones will be very steep. So as the tenor gets longer, the yield is going to also be very steep. Next slide. So key risks for fixed income investing. So the next one, after talking about credit risk, you have here interest rate risk. So this is the change in the bond price or the value of the bond due to changes in the level of interest rates. So as I mentioned earlier, sensitivity is higher for longer tenor bonds, but you have a pull to par as a bond, as the bond approaches maturity. Inflation risk, this is the risk that you're going to have an erosion in the bond's purchasing power. You have to remember that most fixed income securities pay fixed coupons. So during regular intervals, you receive a certain amount, a fixed amount for the duration of the life of the bond. So if inflation is rising, the income that you receive may not be sufficient to cover for inflation already. So that is the concept here of inflation risk. In general, inflation risk is also accompanied by a rise in interest rates, which is detrimental to the price of the bond. And then the next one is liquidity risk. So this is the risk of being unable to sell the bonds in the secondary market at a reasonable price. So most bonds are actually listed and traded in the secondary market. But for most corporate bonds denominated in pesos here in the Philippines, liquidity, I would say, is quite low. So you're not, post-issuance, a lot of them are going to be warehoused. So you don't encounter a lot of them in the market. So if you want to trade them, if you are going to sell them, you have to sell them at a very low price. If you want to buy them, you have to pay a very high price. So that's the concept of liquidity risk here. Reinvestment risk is the risk that the cash flows achieved with the bond will have to be reinvested at a lower rate due to a decline in interest rates in the market. Of course, if interest rates are declining, that also means that the face value of your bond is increasing. But the only way you can realize your yield to maturity, well, this is already theoretical, is that if you are investing all of the cash flows received from this bond at the same yield to maturity, at the same yield. So the reinvestment risk here means that you are unable to invest those cash flows, thus at the same level, thus your yield to maturity will not be realized. And this can also apply whenever the bond has a call option. Because remember, the call option is a benefit to the issuer. So why would the issuer call the bonds later in the future? The only reason the issuer will call the bonds is if the level of interest rates in the markets are lower, meaning he can refinance at lower interest rates. So if he refinances at lower interest rates, the bondholder will be repaid par or very close to par, 101, 102, and they will have to reinvest at very low interest rates. So that is reinvestment risk for the bondholders. And in certain cases, of course, if you're investing in foreign currency bonds, you will also have to deal with foreign exchange risk. Next slide. So example, moving on to an example. So this is an actual term sheet. San Miguel bonds, so this is currently on offer. So if any of you are interested, kindly get in touch with your friendly sales representative or any of our representatives from our camp. So first, issuer, the first line, you see San Miguel Corporation, a very large corporation here in the Philippines, well-known, very well-known brands. You have Pure Foods, you have San Miguel Power, you have San Miguel Tollways. So this is a well-known entity, very familiar to most of you, especially those who drink beer and gin. Instrument, so fixed rate bonds, offer size, this is the face value of the bond. So this is 20 billion with oversubscription of up to 10 billion. Meaning if there is sufficient demand, they can increase the issuance size from 20 billion to 30 billion to accommodate the additional 10 billion oversubscription. The offer, Philippine denominated, peso denominated 6-year puttable bonds due 2027. So here you already see the put option. So there is a put option. And again, the put option is a benefit to the bondholder. So the bondholder has the option to force San Miguel to redeem the bonds by 2027. Is what this is saying, with an aggregate principal amount of 20 billion pesos. Okay, the bonds will be issued from the shelf registration. Okay, meaning they already have an existing shelf registration with the SEC for this issuance. Use of proceeds, then form and denomination. Let's move straight to the bondholder put option because I think I've encountered a lot of questions. I've seen some questions come out related to this one. So for the put option, what is it saying? The terms and conditions of the offer bonds provide for the following put option: 3-year put option on the third anniversary of the issue date, meaning on the third anniversary, the bondholders shall have the right but not the obligation to require the issuer to redeem the notes at face value. So meaning they will be redeemed at par on year 3 for all of the bonds registered in such bondholders' name. So what's going to happen is that why would the this actually gives some flexibility to bondholders, because, for example, this is a 6-year bond, but by year 3, if, for example, there is some need for liquidity, or the bondholder decides that, okay, I want to buy a property because the market has changed, there are a lot of cheap properties now, or oh, I would like to enter the stock market because I think there was the economy is improving, so I think there's very good outlook on the Philippine stock market compared to what we have today. So I think I would like to have that flexibility. So it is the flexibility provided to the investor. They can do that on year 3. You can put the bond and say, San Miguel, I want my money back because I need it for something else. So that's what this is doing to the investor. And for example, if you have no need for your money, you can also retain your investment with San Miguel, and there is going to be a step up as we are going to, a repricing, sorry, as we are going to discuss later. So interest rate, 3-year plus 100 to 155%. So the 3-year BVAL is your risk-free rate. So that is the benchmark rate. That is a Philippine government bond. And the 100 to 155 basis points is your credit spread. So that is the spread according to San Miguel Corporation for the perceived risk attached to them by the market. Next slide. Next is interest rate repricing. So if the put option is not exercised, meaning the bondholder decides to retain their investment in the bond, there will be a repricing on the bond. So it is the higher of either A, the initial interest rate, meaning the interest rate for the first 3 years, or the sum of the interpolated 6-year BVAL, the risk-free rate for 6 years, plus the initial credit spread. We have an actual illustration for this one later, and we'll move on to that one. Can we skip to the next slide first for a moment? There. So this is the illustration that we're talking about. So first, from the issue date to year 3. So if, for example, so this is the most current runs that we have. This was sent out this morning. The 3-year BVAL level is at 2.6242%. Your initial credit spread coming from the term sheet. So it's 100 basis points to 155 basis points. So for this illustration, we are going to choose the lower end of the range. So if at 100 basis points, your gross coupon rate comes out to be 3.6242%. So at year 3, for example, the 6-year BVAL is at 3.5%. The interpolated 6-year BVAL is 3.5%. And your initial credit spread, you're going to recycle the initial credit spread used during the initial repricing. So the 100 basis points, assuming that it was 100 basis points, then we use the same 100 basis points there, and you're coming up with a BVAL plus spread equal to 4.5%. So since 4.5% is higher than your initial coupon rate of 3.6242%, the new coupon rate is now going to be 4.5%. Now, under scenario 2, for example, interest rates drop. The 6-year BVAL is just 2.5%. You apply again the same 100 basis points initial credit spread. The sum of BVAL plus the spread is 3.5%, which is lower than what you are already receiving from the issue date to year 3. So in this case, we are still going to use the 3.6242%. Hindi natin bababaan yung interest rate, meaning, all right? So it's either just you maintain the same interest rate or it's going to increase depending on how interest rates move in the future. So that's how this bond is going to work. On the next slide, I told you about having some certain reference securities. So we are going to talk about how we look at the bond table. So in the, you're also going to find this at the daily rise if you're receiving the daily rise at the back end of it, we publish certain reference credits that are available in the market. So this is for reference, like what are available in the market. So if you take a look at it, so you have issuers, you have, this is grouped based on type of issuer. So first you have foreign sovereign Philippine issuers, then you have Philippine banks, Philippine corporate bonds. Then the next one, you will see the ratings. So those are the credit ratings. MSF means Moody's, S&P, and Fitch. So the Philippines is Baa2 with Moody's, triple B plus with S&P, and triple B with Fitch. Now the security here, that's the identifier that you use in Bloomberg. So you don't need to pay much attention to that one. Next one will be the maturity date. So again, this is the date that your bond is expected to be fully repaid. So if it's bullet, you receive the full principal amount at maturity. Bid price and offer price. So these are the prices of the bonds available in the market. The offer price is the price that the investor will be able to purchase the bonds. And the bid price is the price where the investor will be able to sell in the market. So again, on the concept of prices, you would see that a lot of these are actually above par. Par is 100. So you are seeing 115, 146, 108. So meaning, again, given the reverse relationship with yields, the yield has moved below the coupon rate of the bonds already. So if you will go back to the security identifier, Philip, you're going to see the next numbers there is the coupon rate. So you will see Philip 7.5, 7/1/2. So that means the coupon rate is 7.5%, and the yield, the offer YTM, is 2.3%. So meaning the yield is way below the coupon rate of the bond, which is why the offer price and the bid price are also substantially above par right now. So it's trading at a premium. So that is how you read the bond table. So you have the maturity date, the bid price, and the offer price. Bid price is where you sell your bond. Offer price is where you purchase it. Bid YTM is the yield when you sell the bond, and the offer YTM is the yield that you are going to receive when you purchase the bonds. Now, the next two columns here is bid YTC, offer YTC. That means yield to call. So if the bond is callable, that is the yield available until the call date. So for example, in our example for San Miguel, that would be equivalent to the yield until 2024. Meaning we are assuming that the bonds are going to be called. So same thing how you look at yield to maturity, but yield to call is just until the call date. So you're going to see for several of these, you also have some bonds yielding over 3%, 4%, and relative to the interest rates right now at the market, given that, for example, the U.S. Treasury is at 10%, at 1.6, less than 1.6%. So these are offering relatively good value. By the way, these are all dollar-denominated bonds. Subsequent slides are just more of the same. So you're going to see more bonds here. Next slide, please. There are more bonds here. So you have also Philippine corporate perpetual bonds. And of course, even if the maturity is perpetual, you will see the column here, it says perpetual. All of them have yield to call and yield, bid yield to call and offer yield to call. So meaning all of them are callable. So these issuers, some of them are AC Energy, ICT, Jollibee, Petron, and San Miguel. Very strong issuers as well. Then you also have other issuers here, like the Republic of Indonesia, you have Middle East, and Government of Oman. And in the next slide, you will also see some issuers from China. So I would say in relation to what Mike has already discussed, there are still a lot of opportunities in the market, even if we say that the yields have actually decreased. If we look harder, there are a lot of good quality names that actually offer us good value. So on the next one, on the next slide, this is the last few slides that we have. Next slide. Here is a sample bond calculation. So for example, if you have another bond that is currently on offer, you have the Ayala Corporation bond. So it comes at two tenors. One is 2024, the other one is 2026. So 3 years and 5 years. So face value, for example, you have 10 million pesos. So this is how you're going to compute it. The coupon here, you're going to see the coupon portion. It says coupon of 3.0434%. Again, we also chose the lower end of the range. And the yield to maturity is also 3.0434 because it is issued at par. So the purchase price is going to be 100 par share. So because the coupon rate is equal to the yield to maturity. So that's what it means. But there's also going to be some fees. The 15,100 pesos. So what's the breakdown of that one? You have a brokering fee of 15,000 pesos and a PDTC transfer fee of 100. So the total cash out to the investor is 10,015,100. On the next slide will be the computations. So the gross coupons, meaning if you apply the coupon rate discussed in the previous slide of 3.0434%, that will be regular payments of 76,085. So that will be the gross coupon. And if you remove the tax of 20%, your net coupon will be found on the right. So if you sum it all up, the total cash inflow to the investor, which is cash in, is 10,730,416, and total net interest received is 715,316 pesos. So the indicative net PRT rate, or the net the net interest received by the investor is 2.346%. So the PRT, this is simply the sum of your coupons, the net coupons, so the last column. If you sum it all up and you divide it by the cash out, which is 10,015,100. So you include the fees and you use the net coupons para walang tax. So the net return to the investor is 2.3460% throughout the life of the bond. And this is assuming that all of the cash flows have not been reinvested. If the investor is reinvesting those cash flows, the net return should be higher. So next slide, this is just for the 2026, but same concept, issued at par. Maturity is 2026. Gross price is 100. So par value 10 million. Total cash out 10,015,100. In this case, since this is a longer tenor bond, they will be receiving more interest payments. So the net indicative PRT rate is also higher. The return to the investor is much higher compared to the previous one. So that's the end of my presentation. Thank you for your time and looking forward to answering your questions in the Q&A portion. Back to you, Claudine.
Okay, thank you so much, Roy. So we immediately move to the Q&A. I believe a lot of people have already raised their questions in the chat box as well as in the Q&A box. And I thank our panelists who have already started to answer the questions posted in the Q&A. So may I call on to bring back on screen our panelists for the Q&A. So we will start with the head of Retail Relationship Management Division of the Trust and Investments Group, Attorney Ria Carpio. From our RCBC Treasury, the head of our retail head of treasury sales, Steven Reyes. We're bringing back our chief economist, Mr. Mike Ricafort, and then Roy Velasco of Client Advisory and Brokering will also join us. And for RCBC Capital, we will be represented by Mr. Javi Jalcita. Okay, so for the Q&A, I believe some of the questions have already been answered. I'll just read some of the questions that we would like to answer live here. So for the first question, this is for Mike Ricafort. The target is 140 million vaccines by year end. How confident are you in the government meeting its supply schedule? Vaccination success has impact on our GDP. So how will this potential delay or potential shortage in our vaccines may impact our GDP forecast? Mike?
Yeah, that's actually, Claudine, that's true. The target is high. No? Actually, that's the most optimistic scenario. But reality check, especially now, there's still global tightness. That's why we only have a total of around we're just moving to 8 million. No? We're still short of 8 million, and the inoculation started March 1. So we're already 2.5 months, and 140, that's still too far, no? Considering that, well, at least little by little, in like the last ones that we had, the country had, in terms of arrivals, 2 million AstraZeneca, 1.5 million Sinovac, and so, well, that's kind of tough, no? Kasi even Malacanang is very transparent in saying it's not necessarily this year. That may be a ambitious target, but it could realistically roll over and spill over into next year. So, yeah, hopefully that answers the question. Kasi right now, ano pa eh, there's still the tightness is still there, no? It would even be even the supplies from India, the Novavax. I think that's our biggest supply deal so far, 30 million vaccine shots. That one would be delayed. No? We all know kasi what's happening in India. There's a disruption, and they also need the vaccine shots there. Well, uh, among other supplies on the medical side. No? So yeah, that's a reality check. It could even be spilled over during the election year 2022, or maybe even the latter part of next year. So that's kasi even our calendar, parang for next month, say for June, we're just talking about 10 million eh. Parang lumalabas na on a monthly average, we only the reality what's realistic now is around 10 million to mataas na yung 15 million per month till the end of the year. So if you do the math, so baka we might end the year, kung sabihin na natin, sige, 10 million, so we still have, practically we have 7 months to go, no? So baka papunta lang sa 100 million. No? Pero nonetheless, malaking bagay pa rin yun kung umabot sa 100 million. Considering Philippines is now number 2 in terms of vaccination in ASEAN. Marami na yun sa lagay na yun. No? Kasi hirap nga yung supply last month eh. Pero it's catching up. No? Kasi nakatulong din yung connections with China and Russia. No? In view of the delay in the Western vaccine. So hopefully that helps it. Kasi our recovery would largely depend on that. Dumating yung marami vaccine. Parang nakita natin sa US, gumanda yung data, bumaba yung cases sila, gumanda yung economic data. Para sa China, ganun din naman yung those who have been countries that have been doing good, no? Doing much better in terms of recovery. So hopefully that answers the question. Thank you.
Thank you, Mike. That question was from Mr. Ariel Santos. I'm moving now to the Q&A box. So, there have been 9 questions already answered by our panelists. So for the 2 open questions, when can we receive the interest payment on the fixed bond? Is it after 3 years? Or if we opt to do that, I was advised by someone na makredit siya quarterly. Paano to? Thanks. Anybody from our panelists may take this?
Yeah. I'll take this. I think
for I wanted to take it.
Yeah,
okay,
for
go
most
ahead,
bond offerings, it will be paid quarterly. So you will be receiving the interest payments on a quarterly basis.
Yes. So if this is referred to the AC bonds or the SMC bonds, the interest payments would be made quarterly based on the terms and conditions. And the maturity will be on the 3rd year, or the call option date for SMC will be on the 3rd year. Or sorry, the put option date for SMC will be on the 3rd year. Okay. So for the chat box, there's a question from Leonisa. From Miss Leonisa, how much is the lowest bond we can invest in RCBC, and how long or what is the shortest time we can get the interest. So this is from ating Kooperatiba MPC Tagkawayan Quezon.
Hi, Lenisa. This is Steven. The universe of investments is actually very broad, and it definitely depends on the risk appetite that you and your cooperative are willing to take. I've actually sent you my email address, and if you could just get in touch with me, and I will have someone walk you through the whole process of investments in fixed income. Thank you.
Thank you, Steven. From Miss Winnie Yu, if client opted to hold on with the SMC bonds after 3 years, will there be a possibility that the rate is lower than the first 3 years? I believe Roy has presented earlier how the put option will operate. So if we will reprice on the put option date on the third year, um, we will revisit, we will apply the interest rate will be repriced based on the applicable benchmark rate at that time plus the initial spread. But the rate should not be lower than the prevailing that should not be lower than the rate prior to the put option date. So if ever we will price the bonds for the first 3 years at what's the example, Roy? 3.4262. The second year will not be lower than 3.4262%. Then next question from TJ Akob. Is the redemption of the issuer contingent on the voting process by the bondholders, or is there a minimum number of bondholders who must exercise the bondholder put option for the issuer to redeem on the third year? Abby, would you like to take this?
Yeah, the put option is actually voluntary on the part of the bondholder. So not, for example, we have 100 bondholders. Not everybody needs to exercise their put option. With regard to the redemption, I think it's up to the issuer if they want to redeem it. But I understand in this case they can only redeem starting after the third year, right? Maybe I think it's the fourth, fifth, and sixth.
2024.
Yes.
They can only exercise the call option on 2024.
Yeah. For the call option, that's correct.
Yep.
For the redemption, coming from the issuer, I think that they can usually it's in the last 2 or 3 years of the issue.
Okay. Yeah, and I saw that Stephen also indicated his answer. Thank you, Stephen. But I believe for this, for the before the put option, there will be an announcement also that will be made to all bondholders that announcing that you will asking you to exercise your put option. So the next question we have, this is for Mike Ricafort. I saw that. Oh, Mike, did you answer that already? Okay.
There's a
Which one?
There's a question here from Alisa. She's asking if she could order online. Well, currently we don't have an online ordering facility yet. What you can do, however, is to go to your branch. Definitely, the branches have been advised already on how to facilitate orders of clients. If that is, you don't have a relationship manager that handles your account. If you do have a relationship manager, let's say maybe in Treasury or in Trust, you can more easily as well reach out to your RM. But again, like I said, if you don't, please just go to your branch to facilitate the intent to invest.
Thank you, Stephen. Mike, there's a question, follow-up question on the GDP. I sorry, this is relating to the peso.
Yeah, go ahead, Claudine.
Okay. I think you answered it also. What is your year-end projection for the US dollar to the peso? So I think you already posted your answers, range between 48.50 to 49 if recovery in the economy and import remains relatively slower amid the recent lockdowns in NCR Plus. Okay, thank you, Mike.
Yeah, because it's a yeah, if I
Go
may,
ahead.
it's a function kasi if the economy remains relatively slow, the peso remains relatively stronger. If the recovery picks up, if the demand for imports would also pick up and the tendency is for the dollar peso to go up as well. We've seen that since last year, when since the lockdowns, net imports declined by 16 billion and the peso appreciated from 50.63 in end 2019. Now it's down to 47.81. That's the strongest in 4.5 years. So it's very much correlated with our recovery. Yeah, thank you, Claudine.
Okay, thank you, Mike. And the next I have on screen is, can bondholders sell their investments before the maturity date? And the answer is yes. They may sell their investments prior to the maturity date through the deck, and then they may reach out to the clients may reach out to their assigned RMs or account officers should they decide to trade to sell their investment in the market. But these would only apply to listed bonds. So referring to the listed bonds option to sell before maturity date. Okay, next question. Thanks to our economic managers, our credit rating has improved. What is the benefit of the higher rating to the ordinary investor and more importantly to the man on the street who may have experienced hunger during the pandemic? Mike?
Yeah, Claudine, thank you. Yeah, I just saw that also, no? So yeah, definitely from the point of view of the ordinary person, the better credit ratings would definitely lower the borrowing cost of the government because the government always needs to borrow to finance its budget deficit. So it can borrow at a lower cost and at better terms, no? Even much better terms like longer tenor, because that's a benefit of having a higher credit rating for the country. That would allow a bigger spectrum or universe of investors that are allowed to put money and to lend to our country. So we have more lend. We can borrow from more creditors and much lower cost because our risk is much lower because of the better credit rating and with much better terms in terms of very long. Well, for multilaterals, we're talking about as long as 20, 30, or even 40 years of borrowing. So that would help that would definitely help the country, especially for funding various developmental programs and also including the funding for vaccines. That's also included there. So hopefully that answers the question. Thank you.
Thanks, Mike. The next question I have, what will serve as my proof of investment? Attorney Ria, can you share what trust would normally issue?
Hi, Claudine. Yeah. For investments done with trust, proof of investment will be a confirmation advice that shows the security that you purchased and then all of the terms. It also includes a cash flow of more or less the program payments that you will receive and the expected dates of when these payments will be received. I understand for investments with Treasury, the same also applies. There's also a confirmation of investment that will be given to the clients.
Thank you, Attorney Ria. And I believe for orders going through RCBC Capital, we'll be issuing an OR to confirm receipt of payment. And then, okay, next question in the Q&A. The net yield of SMC is lower than inflation. Do you think SMC is a good buy? May I ask Steven to take this question?
Yeah, sure. The inflation that you are seeing right now, which actually Mike also touched on during his presentation, is what we'd call a lot of it boils down to base effect, meaning because last year inflation was very low, the inflation of this year will naturally be much, much higher. But definitely, the question is whether it is actually temporary or whether it will be the way going forward. And I think the answer there is that it is going to be temporary. And major central banks all over the world have all been in agreement that the inflation that you will see in 2021 is what they'd call transitory. So even if the inflation that you're seeing right now is on the high side, and some of these bonds that you're seeing is also uh, maybe a touch lower or at that inflation number, I think that you look at it from a not an immediate perspective, but look at it from a slightly medium term perspective. Where do you see interest rates going forward? Maybe about 3-4 years from now. Is it going to be much higher, or is it going to be back to where it was prior to the pandemic? If you remember, our inflation before pandemic was in the low side of the 2 to 4% range that the BSP had. And if we are to get back there, based on the forecast of Mike, as early as 2022, then you should be doing well with your San Miguel investment. Particularly because note that it has a put option, which means that it is technically can be a 3-year investment for you, and at the same time it has a floor feature, meaning it cannot get lower than that. So I think those two features that were provided in the San Miguel bond, which is a 3-year put and a floor, are two very good protection for investors that can give them value for their money for their investments.
Thank you, Stephen. Hope that you'll be able. Yeah, hope you're convinced that SMC is a good buy. Next question. What? Okay. If I reach the 6-year maturity, what will be my benefit? So I think this is referring to the SMC bond. So you will, on maturity, you will receive the your principal back together with the accrued interest based on the new interest rate for the next 3 years. So that the rate will be repriced in the third year. So whatever that rate, the new rate will be, that will be the applicable interest rate, and then on top of that, that will be added to your principal amount. Okay. Okay. Hi, Stephen. Thanks for answering my questions. You mentioned that risk involved is interest rate risk or mark-to-market risk. So as SMC is offering fixed rate 6-year bond, am I correct to understand that fixed rate is applicable and interest rate risk will not affect this? Second question, investment risk. Because the issuer has the ability to retire the fund in 2024. Are you referring to put option? But I thought this is actually a benefit of the bondholder. You suggested a fixed income for our retirement plan, and we just have to pick a bond issuer we are comfortable with. I believe SMC is a trusted and stable company we can consider, isn't it? So based on the indicative initial rate of SMC, if we purchase 300K, that means we can earn up to 11,000 per year. So that's only 924 per month. What lower fixed income bond investment you can recommend to us with 5 to 6 years term? I think, Stephen, we have to answer this one by one. Okay.
Yeah.
Oh, you want to answer this offline?
Yes, please. I think
Okay.
there are just too many factors that were mentioned
Yes.
that it's best to be answered offline.
Okay. Okay. Thanks.
Uh, we will
Yeah.
be giving also to those attendees here contact numbers and so that if you have additional questions that we were not able to respond to, particularly those that are very detailed questions, please reach out to us through those contact details so that we can hopefully satisfy your questions.
Okay, thank you so much. I believe we have already covered most of the questions, and we have answered a total of 13 in our Q&A box, and have also answered most of the questions in the chat box. So yeah, so I think we can already end the Q&A at this point. So um, so at this point, we would like to call on the head of Wealth Management Group, Ms. Jane Maniago, to deliver the closing remarks.
Thank you, Claudine. Our dear clients and friends, thank you for joining us this afternoon. I believe that we were able to achieve what we have set out to do in this webinar. It is good to have fixed income securities in our portfolio. As Roy Velasco explained earlier, these are investments that provide us with a stable source of passive income. Now, how much are we going to set aside for fixed income? What issues should we invest in? Please do not hesitate to reach out to your relationship managers for further discussions. We are more than glad to help you with your requirements. With this, on behalf of RCBC and RCBC Capital, we thank you for your continued support and patronage. Enjoy the rest of your day, and we look forward to seeing you again in our next webinar. Thank you.
Thank you, Ms. Jane. We hope that you have learned a lot from this afternoon's webinar. Thank you for your active participation. Stay safe and healthy. Good afternoon. Goodbye.